If prices keep rising while your savings stand still, you're moving backward. This video is your clear, calm guide. It's how gold really behaves when inflation surprises, the hidden costs and liquidity traps in real estate, and flexible entry points like ETFs and REITs. By the end, you'll see a balanced path that you can adapt to your budget. No hype, just numbers, risks, and practical steps.
All right, picture this. You're at the gas pump, right? Me watching those numbers just spin. Or maybe you're grabbing groceries, you look at the receipt, and you're thinking, wait, did I buy the whole store? Well, that feeling, that's inflation. It's kind of like this little mouse nibbling away at your wallet when you're not looking. Seriously, it feels like playing financial whack-a-mole sometimes. But the moles are getting faster, and your money feels smaller. It's more than just annoying. It's like this.
Don't forget to subscribe, tap that bell, and let's chat below.
Silent tax messing with the real value of, well, everything you own.
It really is. And, for anyone trying to hang on to their wealth or maybe even grow it, inflation just forces this huge question on you. Where do you actually put your money when everything costs more?
So today we're going to dive deep into two of the oldest players in this game, the ones people always argue about. Gold, that shiny classic, and real estate, good old bricks and mortar. We're going to try and cut through some of the hype, look at the actual numbers, the real risks, and figure out what this actually means for your money, whether you're like Gen Z just starting out, a millennial maybe thinking about buying, or maybe you're a boomer trying to protect your retirement stash. Okay, so we all feel it when things cost more. Right. But for investing, what's the biggest thing that people misunderstand about how inflation really messes with their financial plans beyond just, milk costs more?
Yeah, the really sneaky part for investors isn't just prices going up. It's the slow erosion of what your money can actually buy over time. That number we watch, the CPI, the Consumer Price Index, it's been, stubbornly higher than the Fed's 2% target goal, even after cooling off a bit. Now, for folks on a tight budget, it hits hard on basics, food, gas. Forces really tough choices. But if you've got savings or investments, your safer stuff like traditional bonds or even cash just sitting in a savings account that pays almost nothing, that money is actually losing real value every single year. And that's why people get pushed towards these hard assets, tangible things that are supposed to hold their value better.
Quick favor, hit subscribe, turn on the bell, smash like, leave a comment, and stick around for more.
Things that act as an inflation hedge, basically protecting you from that drop in purchasing power.
Right, so we need things that can stand tall when the financial ground feels shaky. Maybe even do well. Let's start with gold, the classic. The safe haven everyone talks about.
Yeah.
Humanity's security blanket for, forever. But is it always the golden ticket when inflation really bites? Or is that reputation maybe a little exaggerated sometimes?
Gold definitely has its moments, no doubt. Its biggest plus, super liquid. You can buy it, sell it pretty much anywhere pretty fast. Transaction costs are usually low too. And yeah, historically it does really well when inflation is unexpected and takes off like crazy, or when people lose faith in regular money, fiat currency, like back in the 70s with that massive inflation. Or even more recently, say 2023 to 2025, we saw gold prices just shoot up over 90% in 5 years, hit over $3,700 an ounce. And it's not just us regular folks. Central banks around the world, they've been buying gold like crazy too. That pushes up demand.
Wow. Okay, 90%. Those numbers are hard to ignore. But is there ever a time when gold doesn't live up to the hype during high inflation? Does it ever let you down?
Oh, absolutely. It's not a magic bullet. And here's why. First off, gold doesn't pay you anything to hold it. No dividends, no rent, nada. Its value is all about the price going up. That's it. Second, even though we think of it as stable, the price can swing wildly. It really depends on things like what people expect real interest rates to do, the US dollar strength, global vibes, risk on, risk off. Actually, Goldman Sachs even pointed out that gold isn't always great against moderate inflation. Sometimes it even loses value then. And then there's the practical stuff. If you buy physical gold, storage costs money, insurance.
Hit subscribe, turn on the bell, like the vid, and keep it rolling.
Costs money. Plus the difference between buying and selling price that eats into your profit. Oh, and don't forget taxes. Capital gains on gold can be pretty steep in the US, up to 28%.
So the Midas touch, or maybe fool's gold if you jump in without thinking. So if you are considering it, you've got options, right? Physical bars or coins, or things like gold ETFs. Those are easier to trade, like stocks. Things like GLD or IAU.
Exactly. ETFs are much more accessible for most people. Or you could look at gold mining stocks, but that's a whole different risk level tied to the company's performance too.
Okay, got it. Now let's switch gears. Real estate. Everyone knows the saying, they're not making any more land, right? It just feels solid. Dependable, like the ultimate way to build wealth long term. But buying a house or maybe a rental property, is it always a slam dunk when inflation is high? I mean, it's tangible. You can touch it.
Real estate definitely has a strong appeal, and for good reasons. You potentially get two things. Rental income. Major U.S. markets might see yields of maybe 3-5%, and the property value potentially goes up over time. Appreciation. We saw some landlords between 2019 and 2023, their net income jumped like 25-40%. Rent increases help them beat inflation. Plus, a huge advantage is leverage. Using a mortgage lets you control a big asset with, relatively speaking, less money down. That can seriously boost your returns. And then there are the tax breaks. Deductions, deferring capital gains with things like 1031 exchanges. That's a big one for investors swapping properties. Real estate also tends to track inflation pretty well. Construction costs go up, materials, labor, that pushes property values up, and rents. You can often adjust those upwards too.
Okay, sounds pretty powerful as an inflation fighter. But that tangible dream home or rental can turn into a real headache, a money pit, right? What are some of the less exciting truths about owning property that maybe first-timers don't always see?
Well, the big one is liquidity, or rather, the lack of it. Selling a house isn't like clicking sell on a stock. It takes time, months sometimes, and the costs are huge. Realtor fees, closing costs, they take a big bite. Plus, just getting in is tough. That down payment, the closing costs, it's a massive barrier for a lot of people, especially younger buyers. And this idea of passive income, not so fast. Owning property, especially rentals, takes work. Active management. You've got property taxes, insurance, maintenance, surprise repairs. Oh, and vacancies. Empty property means no income, just costs. That can kill your profits. Also, real estate is super sensitive to interest rates. When mortgage rates go up, like they have been, it costs more to borrow, fewer people can afford to buy, and that can slow down price growth or even make prices drop. And remember, location, location, location. Just because U.S. home prices are rising overall doesn't mean your local market is doing well. It varies a lot.
That's a really good point about the barriers. And it's worth saying, too, while real estate has built fortunes, its history is imperfect. Things like redlining, unfair tax assessments, these things made it harder for certain communities, especially communities of color, to even get into the game. Yeah. So the American dream of owning a home, it hasn't always been equally available. It's not just about the spreadsheet numbers.
Absolutely. And speaking of numbers, here's where things get really interesting. We see house prices going up, up, up in dollar terms, but what if those gains aren't entirely real? Let's talk about this kind of mind-bending metric. It helps strip away the effects of just printing more money. It's called the gold-to-property ratio.
Gold-to-property ratio. Sounds fancy, but the idea is actually pretty smart, isn't it? It basically asks, how many ounces of gold does it take to buy the average house? So it cuts through the noise of currency inflation and compares the real value of property directly against gold over time. Gives you a clearer picture than just looking at dollar prices.
Exactly. And when you look at it that way, historically, U.S. home prices in dollars up something crazy like 2,266% long term. But gold, over the same long period, up an astonishing 9,298%. So what does that mean? The real value of a house, priced in gold ounces, has actually gone down significantly over the very long haul. Right now, house prices in gold terms, they're kind of similar to where they were back in the 1980s, way below the peaks we saw in the 60s or the early 2000s housing bubble. It really challenges that simple buy property, always wins story you sometimes hear, especially from certain online finfluencers.
Wow, that really flips the script. So, okay, if buying a whole house isn't practical or maybe doesn't seem as appealing after hearing that, are there other ways to get your feet wet in real estate?
Oh, for sure. Besides owning directly, you can look into REITs, real estate investment trusts. These are basically companies that own or finance property that makes money. Think shopping malls, apartment buildings, office towers. Buying shares in a REIT gives you exposure to real estate, but with way less cash up front. Plus, they trade like stocks, so they're much more liquid. And you get diversification built in. And looking ahead, there's this emerging thing called tokenized real estate. Using blockchain to sell fractional ownership of properties, it could potentially make owning a piece of property even more accessible, especially for maybe like Gen Z investors with smaller amounts to start.
Okay, lots of options, but it's easy to get carried away, right? Yeah. See the potential big returns and jump in too fast. We know people make mistakes. What are some of the common traps that even smart, ambitious investors fall into? Let's talk about those, because learning from other people's mistakes is way cheaper.
Oh, yeah. Huge one. Blindly trusting those finfluencers we mentioned. You see these stories all over Reddit, right? People losing serious money chasing tips from some online guru. They always show off the wins, but you never hear about the losses. Remember Dave Ramsey went bankrupt once? Robert Allen, the nothing down guy, also went bankrupt. Often, they make their real money selling courses or books, not necessarily from their own investing genius. And that hype feeds into FOMO, fear of missing out, makes people make emotional choices. Buying high because everyone else is, or panic selling when things dip.
Ugh, the FOMO is real. Feels like everyone on TikTok became a day trader overnight a while back. But that confidence, maybe not always based on solid ground. What other big mistakes do you see? Especially maybe with younger folks trying to get started.
Getting in too deep with debt, over leverage, and not having enough cash reserves. This is a huge issue, especially for, say, millennials and Gen Z who might already have student loan debt. I think I saw a stat, like 51% of renters say student debt stops them from buying. So maybe they stretched to buy when rates were super low, and then suddenly rates go up, expenses pop up, and they're struggling. Negative cash flow, huge stress. Another big one is just not understanding the total cost, especially with rentals. People look at the potential rent, but they forget vacancy periods when nobody's paying rent. They forget maintenance, insurance, property taxes. All that stuff adds up fast and can wipe out your profit, even if the rent looks good initially.
Right, the hidden costs. And what about just bad timing or needing your money back suddenly?
Yeah, that's the timing and liquidity mismatch. Real estate is not liquid. So if you bought it thinking it's a great inflation hedge, but then you lose your job or have an emergency during a market downturn, you might be forced to sell that property at a loss because you can't wait for the market to recover. We also see people getting overconfident because they only look at a short period, like, oh, real estate did great the last 5 years. Well, yeah, but what about the 5 years before that? Or the next 5? You need the long view. And with physical gold, paying way too much over the spot price, the market price, or forgetting storage and insurance costs, that kills your return right from the start. But honestly, the biggest mistake overall, lack of diversification. Putting everything into gold or everything into real estate, that's just asking for trouble.
Man, these mistakes sound painful, but definitely avoidable with some planning. All right, before we get into the smart strategies to actually do something about this, let's take a quick break for a message from our sponsor name. They're all about giving you the clear, data-driven tools you need for your financial journey. And we're back. So we've established that neither gold nor real estate is some kind of magic shield against inflation. No guarantees. So what can you actually do? The good news, maybe, is that there isn't just one single right way. There are smarter approaches for you, depending on where you're at.
That's exactly it. It's not about picking a winner, gold or real estate. The smart play, according to most experts, is actually combining them. Think about building a balanced, resilient portfolio. Maybe that means having, say, 5-10% in gold. Treat it like insurance for those really crazy times. And then maybe 20-30% in real estate, or those easier to access options like REITs for that potential long-term growth and income. And that's alongside your main investments like stocks and bonds. It's about building layers of defense that can handle different kinds of economic weather.
Okay, diversification. Makes sense. And if you're starting with less money or just want easier access.
There's plenty of options there too.
Right. Like for gold, you mentioned the ETFs, GLD, IAU, easy to buy and sell like stocks, or maybe mining stocks if you're adventurous. And for real estate, REITs sound like a great way in. Smaller investment, more liquid than a house, already diversified.
Exactly. And don't forget things like fractional REITs or keeping an eye on how tokenized real estate develops. The whole point is finding ways to participate that fit your budget right now.
Okay, so let's boil this down to some solid, actionable advice. Stuff anyone can use. First, start small. Totally okay. If buying a property seems impossible, look at gold ETFs, REITs, even just a small amount of physical gold if that feels right. Second, and this is huge, emergency fund first. Seriously. Before investing a dime, aim for 3 to 6 months of living expenses saved up in cash. That's your real safety net, no question. Third, don't forget, cash can be useful. Sometimes, especially when markets are tanking, having cash in a high-yield savings account lets you jump on opportunities. Buy low. Fourth, don't go it alone. Talk to a real financial advisor, someone independent who can give you advice based on your situation, not just selling you something. And last but not least, Keep learning, read stuff, watch videos like this, talk to people. Knowledge really is your best weapon in finance.
And you can definitely tweak these strategies based on who you are and where you are financially. For Gen Z, maybe lower income folks, focus hard on those low-cost entry points, gold ETFs, fractional weights, and definitely build that emergency fund. Priority number one. For millennials, maybe middle income. Really dig into mortgage numbers if you're thinking of buying. Understand the true long-term costs. Balance maybe side hustles with consistent long-term investing. And for Gen X, boomers, maybe higher income. The focus shifts more towards preserving wealth, getting reliable income. So broader diversification makes sense. Physical gold, ETFs, maybe rental properties, maybe even alternatives like commodities or farmland.
That makes a lot of sense. It really brings up that core question, doesn't it? How do you, listening right now, figure out your own goals, your own comfort level with risk, especially when the market feels so uncertain? It's definitely a process.
So let's try and wrap this up. The big takeaway from our deep dive today. Remember, neither gold nor real estate is a perfect, foolproof solution for inflation. They just aren't. They both have good points, and they both have downsides. Gold, great for liquidity, maybe some crisis protection, like an insurance policy if faith in regular money wobbles. Real estate offers potential long-term growth, maybe some rental income, but it's way less liquid, costs more to manage, a lot of hidden expenses. The real key, don't bet the farm on just one thing. Diversification. Spreading your money across different types of assets is still the most reliable strategy we know.
Yeah, absolutely. So considering everything, the numbers, the hidden costs we talked about, the human side of investing with all its emotions, here's a final thought. What if the best inflation hedge isn't actually gold or property? What if it's the knowledge you build, the smart, informed decisions you make with your money? What do you think? What's your take on gold versus real estate? Have you invested in either? Did you run into any of those pitfalls we discussed? Or maybe you found a strategy that really clicked for you. Share your story. Tell us your numbers, what you learned. Drop it in the comments below. Seriously, we want to hear from you. And hey, if this deep dive helped you out, do us a solid. Hit that like button, subscribe to the channel, and definitely ring that notification bell. That way you won't miss our next deep dive into making your money work smarter. Want to dig deeper? We've got other videos you might like. One on the hidden costs of owning a home, another explaining REITs for beginners. Check those out right here.